Gold just crossed $4,343 per ounce this morning. Silver surged past $70 today. SpaceX, the most explosive IPO in the history of human civilization, is trading at $171 this very hour after closing at $160.95 on Friday. And in less than 48 hours, a man most Americans have never heard speak in this role is about to walk up to a podium inside the most powerful financial institution on the face of the earth and say a handful of carefully chosen words that will move every single one of those numbers. His name is Kevin Warsh. He is the 17th chairman of the Federal Reserve, and Wednesday, June 17, 2026, is his first press conference. The financial world has never heard him speak in this role before, and what he says, every syllable, every pause, every carefully chosen adjective, is going to ripple outward into your wallet, your retirement account, your savings, and every asset you have ever considered buying or selling. Now let me ask you something directly. When was the last time you genuinely thought about who controls the price of money itself? Not a stock, not a commodity, money. Because that is what the Federal Reserve actually does. It sets the cost of borrowing. It shapes the value of the dollar. And because the dollar is the world's reserve currency, the decisions made in that marble building in Washington do not merely affect Americans. They reach into every currency, every bond market, every commodity exchange, every equity portfolio on 6 continents. The Federal Reserve is, without hyperbole, the single most consequential financial institution in the history of organized civilization. And this week, for the first time, a brand new chairman is going to sit in its highest chair. That is not a routine event. That is a seismic one. So what exactly do you know about Kevin Warsh? He was confirmed by the United States Senate in a 54-45 vote on May 13, 2026, one of the most politically divisive Federal Reserve confirmations in decades. He was sworn in on May 22nd, replacing Jerome Powell, whose term had ended. He is historically hawkish, meaning he tends to lean toward fighting inflation aggressively, even when doing so causes short-term economic pain. And here is the part that makes this week feel like a slow-motion collision between political pressure and economic reality. Consumer prices in the United States are running at 4.2% year-over-year as of May 2026, up from 3.8% in April. The core inflation figure, stripping out food and energy, sits at 2.9%. Neither number is anywhere close to the Federal Reserve's stated target of 2%. And yet President Trump has said publicly, just days before this meeting, that there is no reason to raise interest rates and that the Fed should lower them. The man who appointed Warsh wants cheaper money. The data Warsh inherited wants tighter policy. And somewhere between those two realities, on Wednesday afternoon at 2 p.m. Eastern Time, Kevin Warsh is going to have to choose his words with extraordinary care. Before we continue, I'd love to hear from you. Drop a comment below and tell me where you're watching from. Are you in the United States? If so, which state? Or are you joining us from another part of the world? It's always fascinating to see how far this community reaches, and I read every comment. Let me know your location and whether you're more bullish on gold, silver, or SpaceX heading into Wednesday's Fed meeting. But here's what the vast majority of investors are missing right now. They are watching the wrong thing. They are focused on the rate decision. Will the Fed raise, hold, or cut? And that is already answered. The probability that the Fed holds rates steady at this meeting sits at approximately 98%, according to the CME FedWatch tool. There is virtually no suspense there. The rate is going to stay right where it is, in the 3.50 to 3.75% range. That is settled. The real story, the one that professionals are losing sleep over this weekend, is the dot plot. And if you do not know what the dot plot is, then you are flying blind into the most important financial week of 2026. The dot plot is the chart released by the Federal Reserve that shows where each individual member of the Federal Open Market Committee thinks interest rates are going to be in the future, 6 months from now, a year from now, 2 years from now. It is not a commitment, it is a forecast. But the financial markets treat it like scripture because it reveals the collective mindset of the people who actually control the price of money. And when that dot plot is released on Wednesday at 2 p.m., the markets are going to react before Kevin Warsh says a single word. And then at 2:30 p.m., when he begins to speak, the second wave of reaction is going to hit. And that second wave is the one nobody is fully prepared for. What makes this meeting even more unusual is that markets are entering it with a level of confidence that borders on complacency. Traders believe they already know the outcome. Analysts have published their forecasts. Financial television has largely settled on its narrative. But some of the biggest market shocks in history happened precisely when investors thought there were no surprises left. In December 2018, markets expected one path and received another. In 2022, inflation proved far more persistent than experts predicted. Time and again, the moments that changed portfolios forever arrived when consensus was strongest. And right now, consensus is telling investors that Wednesday is routine. Yet routine events do not usually arrive with gold at record highs, silver near historic levels, and a brand new Federal Reserve chairman stepping into the spotlight for the very first time. What should concern investors is not what Kevin Warsh says directly, but what his language reveals beneath the surface. Every Fed chairman inherits an economy. Every Fed chairman inherits inflation data. But the first press conference is different because it reveals something much harder to measure: philosophy. Does he view inflation as the greater threat or economic slowdown? Does he prioritize market stability or price stability? Is he willing to tolerate short-term pain to restore long-term confidence? The answers may not appear in a headline, yet institutional investors will be searching for them in every sentence. And by the time most people realize what message was actually delivered, the largest moves in gold, silver, and risk assets may already be underway. There is a scene that repeats itself throughout financial history, and it is always the same scene. Markets grow quiet, trading volumes thin out, the news cycle softens, investors exhale. And then something happens that everyone intellectually knew was coming, but nobody emotionally prepared for. And in that gap between intellectual knowledge and emotional preparation, fortunes are made and fortunes are lost. We are living inside that gap right now on this Monday morning, as gold moves higher, as silver pushes toward levels not seen since before its catastrophic 30% single-day collapse on January 30th, 2026, when the CME Group raised margin requirements and unleashed a cascade of forced liquidations across the entire precious metals market that left silver traders staring at their screens in disbelief. That crash, which took silver from its all-time high of 121.67 per ounce in January, all the way down to levels that seemed impossible, is still fresh in the memory of every serious precious metals investor. And yet, even after that brutal correction, silver is today trading near $70 per ounce, which means that anyone who held through the terror and the headlines and the panic is sitting on gains of roughly 87% over the past year. Think about what that means. Silver's worst year in recent memory, the year it crashed 30% in a single day, is still a year where long-term holders nearly doubled their money. That is the paradox of volatile assets in structural bull markets. The volatility is real, the pain is real, but so is the underlying current carrying prices higher. And the question that every silver investor needs to answer this week is whether the Federal Reserve's messaging on Wednesday is going to accelerate that current or interrupt it. If you are not yet subscribed, this is the moment to do it, because what comes next, the scenarios for gold, silver, and SpaceX over the next 72 hours, is the kind of framework that separates investors who understand the architecture of markets from those who simply react to price movements after the fact. Hit that subscribe button right now. This is the analysis that matters, because here is what the architecture looks like. There are two paths out of Wednesday's meeting, and they diverge sharply. In the first path, Kevin Warsh emerges from that press conference sounding what the financial world calls dovish, meaning he emphasizes slowing growth risks, signals flexibility in future policy, and hints that the Fed may be closer to cutting rates than the current data would suggest. In that scenario, gold, which is already trading at $4,343 today, up significantly from Friday's close of approximately $4,187, likely continues its ascent toward the $4,500 to $4,725 range that the most optimistic analysts have been projecting. A dovish Fed means a weaker dollar. A weaker dollar makes gold more attractive to international buyers paying in other currencies, and it revives the core narrative that central banks will continue debasing their currencies over time, which is one of the fundamental reasons investors have poured money into gold at levels that would have seemed fantastical just 3 years ago. JP Morgan, for context, is projecting gold could reach $6,300 per ounce by the end of 2026. Goldman Sachs has pushed its expected rate cuts entirely into 2027. These are not fringe predictions. They are coming from the biggest and most sophisticated financial institutions in the world. In the second path, Warsh sounds hawkish, meaning he doubles down on inflation concerns, signals that rates may need to go higher before they go lower, and the dot plot reveals that Federal Reserve officials are contemplating the possibility of another rate hike before year-end. In that scenario, gold faces immediate downward pressure. The dollar strengthens, international buyers retreat, and silver, which is even more sensitive to rate expectations than gold because of its industrial demand component, could retest its support levels in the $63 range or potentially lower. And as for SpaceX, which today is trading at $171.72 per share, up sharply from Friday's close of $160.95, already reflecting the surge of optimism following the US-Iran ceasefire announcement this morning. A hawkish Fed would cool some of that enthusiasm by raising the discount rate that investors apply to future earnings, which makes high-growth companies worth less in present value terms. But here is the third force that nobody on Wall Street is talking about loudly enough, even as it transforms the landscape in real time. This morning, gold climbed past $4,338, and silver surged past $70 because of a single headline. The United States and Iran have reached a ceasefire agreement, with a formal signing reportedly planned for Switzerland on June 19th. The deal is said to include sanctions relief, the lifting of blockades, and the dismantling of Tehran's nuclear program. And the immediate impact of that news was exactly what economists would have predicted. Oil prices fell to a 2-month low. Energy inflation expectations retreated. And suddenly, the macro argument for the Federal Reserve to remain aggressively hawkish got a little bit softer. Because of the primary driver of that 4.2% inflation rate, gasoline prices up 40.5% year over year because of Iran-related geopolitical risk, begins to unwind as oil prices fall, then the data Kevin Warsh walks into that meeting with on Tuesday morning may already be quietly shifting beneath his feet. There is an old observation in financial markets that the most dangerous words an investor can utter are "this time is different." Markets tend to rhyme, patterns tend to repeat, and human psychology tends to be reliably, predictably irrational, in the same ways across decades and centuries. Greed at peaks, panic at bottoms, complacency in the calm before the storm. And right now, the calm is deceptive. SpaceX, which 3 trading days ago did not exist as a publicly traded company, which on June 12th completed what is formally the largest initial public offering in the history of human civilization, raising $75 billion in a single day and pricing its shares at $135 before they soared to an intraday high of $176.5 too, and closed at $160.95. That same stock is now trading at $171.72 this Monday morning. Its market capitalization stands at approximately $2.11 trillion. Elon Musk crossed the $1 trillion threshold in personal net worth during the IPO, and Wall Street analysts are projecting price targets ranging from $63 per share on the bearish end all the way to $227 per share on the bullish end, a range so wide it tells you something important. Nobody actually knows where this stock is going, because there is no true comparable. There has never been a company quite like SpaceX. There has never been an IPO quite like this one. And that is the nature of the moment we are living through. Not one extraordinary thing is happening. 3 extraordinary things are happening simultaneously. A brand new Federal Reserve chairman is holding his inaugural press conference during an inflation crisis, while a geopolitical ceasefire unfolds in real time, while the most anticipated stock in a generation navigates its post-IPO volatility phase. These 3 forces do not simply add together. They interact with each other in ways that are non-linear and difficult to model. And that is precisely why the professionals, the institutional portfolio managers, the macro hedge funds, the fixed income desks at the major banks, are running scenario after scenario this weekend. They are not doing this because they know what is going to happen. They are doing it because they know they need to be ready for anything. So what is the framework that every serious investor should carry into Wednesday? It begins with this foundational principle. The rate decision is noise. It is decided. It will not move. What matters is tone, language, and the dot plot. Listen for specific phrases in Warsh's press conference. If he says something to the effect that the committee remains data-dependent and sees risks on both sides, that is a deliberately neutral message, one designed to avoid spooking markets in either direction. If he uses language suggesting the Fed is prepared to act further if necessary on inflation, that is hawkish. If he emphasizes signs of moderation in the underlying price data, that is dovish. These distinctions are not subtle to the people who trade on them. They are enormous. And the initial market reaction in the minutes following that 2:30 p.m. press conference is going to be fast, violent, and not always in the direction that the long-term fundamentals would suggest. Because that is the other thing every investor must understand. Short-term reactions to Fed meetings are frequently wrong. The market's first instinct, the knee-jerk move in the 30 minutes following a major policy announcement, is often reversed within 24 to 48 hours, as investors have time to read the full statement, absorb the dot plot, and think clearly rather than react emotionally. The investors who win in these environments are not the fastest. They are the most prepared. They have already thought through the scenarios. They have already decided what each outcome means for their portfolio. And when the storm hits on Wednesday afternoon, they are not scrambling to figure out what just happened. They already know. They decided ahead of time. For gold, the structural bull market thesis remains intact regardless of what Warsh says on Wednesday. Central banks around the world continue buying gold at a pace not seen in decades. De-dollarization trends are accelerating as nations seek to reduce their exposure to U.S. dollar-denominated reserves, and the long-term fiscal trajectory of the United States, with debt levels that are structurally incompatible with the interest rates needed to sustainably fight inflation, creates a permanent tailwind for a metal that cannot be printed. These forces do not disappear because of one press conference. But one press conference can absolutely change the timeline and the speed of what was always going to happen. For silver, the gold-to-silver ratio now stands at approximately 62 to 1. Historically, when that ratio rises above 60, silver has tended to outperform gold in the months that follow. That is not a guarantee. It is a historical tendency. But it is a tendency with a long and consistent track record. And for SpaceX, the honest truth is that the fundamental question, is this company worth $2.11 trillion, will not be answered by Wednesday's Fed meeting. It will be answered over years, as Starlink builds out its global subscriber base, as Starship achieves its operational potential, and as the commercial space industry either validates or challenges the extraordinary premium the market has already assigned to this company's future. But here is the final lesson, and it is perhaps the most important one. The investors who will look back on this week and be glad they were paying attention are not necessarily the ones who made the perfect trade. They are the ones who understood what was happening and why. Understanding does not always mean acting. Sometimes it means knowing when to be patient. Sometimes it means knowing when to hold. Sometimes the most valuable thing an investor can do in a moment of maximum noise is to sit still and watch with clear eyes. And clear eyes in this moment see the following: gold at $4,343 and rising, silver at $70 and accelerating, SpaceX at $171 and still finding its level, a ceasefire that changes the macro backdrop, and Kevin Warsh walking toward a podium on Wednesday afternoon, carrying the weight of 330 million Americans' economic futures in the precise choice of his next few hundred words. That storm is 48 hours away. The question has never been whether it is coming. The question is whether you were watching. Leave a comment below and tell me this. Are you more bullish on gold, silver, or SpaceX heading into Wednesday's Fed decision? I read every single comment, and your answer might just shape the next video. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk in mind.